Welcome, everybody. My name is Jeff Green, president of Green Team Realty. Thank you for joining me on the November 2018 Housing Market Update. Let's jump right in and check out some information that we've prepared for you. Very exciting time in the housing market right now as we're starting to see some shifts. We've been experiencing all-time highs, 2008 highs, approaching the greatest highs of 2005 and 2006 over the last 18 months, but it does seem that things are cooling off. Here's some interesting info from some people that are well known in the industry. This gentleman, Michael Frattitoni, he's the chief economist for the Mortgage Bankers Association. This pretty much sums it up right here. He expects that home sales growth will pick up again over the course of the next year, even with somewhat higher mortgage rates, but the pace of home price growth will likely slow. So that's interesting. He's saying, despite the fact, and I'm going to show you some national numbers as well as local numbers, the velocity of home selling is actually slowing. It really is. But it looks like he and some others are actually predicting that that is going to increase once again in 2019. So it's not that appreciation is going down necessarily, it's just slowing down. That's the message from him. So let's take a look at some national numbers here. Again, down here we have the MBA, which is Mortgage Bankers Association, NAR, which is National Association of Realtors, Freddie Mac and Fannie Mae. 17 is in gray, 18 in light blue, 19 in dark blue. You can see that all of these entities, with the exception of Fannie, is predicting increases over both of the previous years. All of them are predicting increases over the past 2 years. The past year. So it's just interesting. Now, one thing I will say is that for the most part, every one of these organizations wants the housing market to continue to go, right? It's in their best interest for the housing market to go. So you have to always take everything with a grain of salt and know and understand what source of information things are coming from, because I can tell you that I lived through the downturn, when things really went AWOL in 2006, 7, 8, and a lot of these same organizations were putting out information that wouldn't lead one to believe what was really happening. I'm not necessarily saying that they were fudging numbers, but it's in their best interest to keep the housing market, going. So take it with a grain of salt. You can always count on good, accurate information and honest advice here on the Housing Market Update. So that's just some information from a national perspective. Again, projected home price appreciation growth on a percentage basis, you can take a look at, what they projected in 18, 19, 20, 21, and 22. So a lot of these organizations haven't made predictions through 2019, beyond 2019, I should say. But needless to say, pretty much everybody seems to have a positive outlook in terms of the market continuing to appreciate, but at a slower pace. And, before I make my comments, I'm going to want to hear from the panel, which we're going to get to in just a minute. But let's take a look at some hyper local statistics and analytics here. So this is Orange County, New York, okay, one county, small data sample, but needless to say, reflective of the national numbers that you see. You can see in 2018, and this is really the most important chart of them all, which is number of units sold. It just shows how many homes are actually selling, because quite frankly, that's what it's all about. Prices are going to increase and decrease depending on how much inventory is out there. And if homes aren't selling, then it's just, price isn't going to gain any traction. So you can see it's been a mixed bag this year versus last year. It's been up, it's been down on a year-over-year basis in Orange County. Here's a look at average price. Average price is, having a very good run this year, and price always lags activity. As long as I've been watching stats, for the last 14 years here, very closely, I've been watching the housing market, as that's how long I've been in it full time. And I can just tell you from all the charts I've ever looked at, there's always at least a 6-month lag. If you start to see a slowdown in the activity, 6 to 8 months later, you'll start to see a slowdown in the rate of price increase. Sold to ask ratio, this is just telling you, at what percent of the asking price are homes selling for. So the higher you are to 100%, the hotter the market. you can see that that even took a little dip just recently. But needless to say, it's still at very high historical levels. Now we'll go down to the New Jersey side of the border and take a look at Sussex County. Again, one county in a whole state and one of 50 states in the US. So it's a small data sample, but again, reflective of what's happening nationally. Again, a mixed bag. You can see that the number of units sold has been up, it's been down, it's been, basically flat, if you will. It hasn't been much of an increase. So here's the average price chart. Now, what we've, seen, and you can just see by this chart, is, average price never really gained a tremendous amount of traction on the Sussex County side of the border as it did in Orange County. And you can see that reflective in this chart versus the last one, where in the Orange County, you saw a marked variance on the upward side for things that have price that has increased in Orange County versus Sussex. Sold to ask ratio, again, at what price off the last asking price are homes selling for? This looks similar to what you saw in Orange County, so on and so forth. So before we go to the panel, we're going to be doing our housing market update on December 11th next month, so please join us there. You can always stay connected at greenteamhq.com/HMU, which stands for Housing Market Update. And thank you to our sponsors over at Really appreciate them sponsoring us. So let's go ahead and introduce the panel. When I say your name, just wave your hand and then we'll begin the discussion. Let's start with Joe and Amy. Joe Moschella and Amy Green of Guaranteed Rate. Joe and Amy are VPs of Lending, and Joe is the branch manager. So guys, welcome. Thanks for being here. Pam Zakowski of Green Team New Jersey Realty. Welcome, Pam. Vicky Garby of Green Team Home Selling System in Warwick, and Karen Gonen of Green Team New Jersey Realty. All right. So Green Teamers, let's unmute the mics, and I want to hear what you have to say. I'm very curious to see. Vicky, we'll start with you, and then maybe Pam and Karen will come back around to you two. So Vicky, we were talking, we were in the figurative green room before the webinar started about how, 3, 4, 5 months ago, you were one of the panelists on the housing market update. And at the time, you couldn't really find much news about a slowdown or a cooling off of the market. And it was just, kind of status quo. And we were seeing things. We were debating where this was really headed. Now it seems that the overall dialogue is that there's definitely a cooling off, but the question is, how precipitously is it going to drop? So your thoughts?
Right. I definitely think that in the field, I've noticed a little bit of a slowdown, certainly, towards the end of fall here. I think part of it is a little bit timing, kids head back to school and a lot of the buyers are out earlier in the year trying to make a move before, school starts. So I think that's natural. What I am finding though, is a lot of people are looking for land. And I think part of it is because we've had low inventory historically, compared to the number of buyers who are out there. And as prices have gone up, I think people are finding, if I'm paying full ask, in many cases over ask, because we've had bidding wars, past spring, I think people are starting to consider building new, and that's consistent with the reports that we're showing. New construction, housing starts will be up. I think it was over 9% in the beginning of the coming new year. So
That's a really good point. So the point that I guess the takeaway from that is you're still seeing a lack of inventory in the marketplace.
Yeah, I do. I definitely have, a handful of buyers who sort of waiting in the sidelines. We're watching, housing, new listings and things all the time, but they're definitely waiting for the right one. But because prices are going up, I think more people are considering new construction as well.
Okay, good points. So Pam, let's go over to you. What do you have to say about the situation?
Well, I definitely see a slowdown since, the summer months, and I see more people like looking for housing, but between the low inventory and it's already the start of the school year, they're kind of taking their time and looking for the right house. And I do still see a lot of investors trying to flip properties, although it's getting harder and harder to find that good deal for a flip.
Yeah, that's a good point. What about appraisals? Does anybody have how are appraisals doing? Are we still having issues at all with properties appraising, or have those caught up now? There's enough comps in the marketplace.
I haven't seen any issues with appraisals. They're all coming in either at asking or a little bit above, like maybe 2 to 4 grand between asking and the actual appraisal. So that's not an issue. The one thing I am noticing is that I'm getting a lot more requests for sellers that are asking for CMAs or for listing presentations, much more than I had over the summer. So that is something that's noteworthy. And I do advise them when I see them that we only know what the market is right now. We don't know where we're going to end up later on. So I definitely always recommend that they get on the market right away because we currently have low inventory. And it would be best to sell now as opposed to hold out to spring market.
Yeah, and maybe what's really going to happen is sellers who have been thinking about selling for some time and have just been holding to wait to see what the market's going to do. And now that they see that it's cooling off a little bit, they're going to roll the dice and put the house on the market, which could ultimately bring more inventory and could ultimately bring more transactions to the marketplace as a whole, because there still is a glut of buyers that still want to buy a home and just can't because there's not a lot of inventory out there. So interesting. All right. So any other comments from the Green Team group here before we head over to the mortgage side of this discussion? Doesn't look like it. Okay. So Joe and Amy, let's go over to you guys. What's going on in the mortgage industry?
So the big news on the mortgage front is over the last probably 5 months, we've seen a steady climb in interest rates. We started the year where the 10-year Treasury note was at 2.21 to start the year, and this week it actually finished or started the week at 3.21. So that the Treasury's gone up 1 full percent. That, along with the Fed starting to stop buying mortgage-backed securities, has caused a liquidity crunch in the market, and that's really pushed mortgage rates up. So we started the year right around 4% on a 30-year fixed rate, and right now we're closing in on 5%. You know, still just right below that 5% number.
Joe, I don't mean to put you on the spot, and I should have, asked you this question a couple of hours ago so you could be prepared for it. But just out of curiosity, where was the bond market at like 4 years ago on a percentage basis? Like, just give me some perspective on what 3.2 versus 2.2.
Yeah, I mean, the bond market. I bring this all the way back to 9/11. I hate to get like that, but the Fed right after 9/11, they didn't want to see the economy spiral down, and they actually jumped in and started dropping rates like dramatically, and they brought rates ultimately down to almost zero.
Right.
And now we're finally seeing the unwinding of these artificially low rates. And I gotta tell you what, we all gotta be thankful for the fact that the Fed eased into this, because if they did not ease into these rising rates, we'd be set back into some type of a recession or something.
Right.
So we've had a very soft landing. The 2.21 to the 3.2 represented about 0.75% interest rate wise. So go back about 2.5 years ago, we were at like 1.2.
Oh, wow.
On the U.S. Treasury, yeah. And then go back prior to that, we were in the 0.7, 0.8 range. So we've seen a steady rise, which, hopefully our economy is strong enough and it can handle it.
Yeah. Yeah. I mean, it had to go up. I mean, they couldn't stay at those artificially low rates for too long,
Absolutely. Some of the other changes that we're seeing in the market today is in the mortgage front is we're seeing technology play a huge role in the mortgage market. We're seeing lenders are able to verify clients' income automatically, verify their assets automatically. They're able to do their applications online. They're able to go through a mortgage process without ever sending any paperwork back and forth. Everything's just done digitally, which is starting to revolutionize the industry, catch up from a technology standpoint to the rest of the world, and it's leading to higher consumer satisfaction. And it's also showing that the industry is easing credit standards at the same time.
Is that necessarily a good thing, easing credit standards?
Well, that's a good point. I mean, me and Amy, one of our other talking points we wanted to talk about was how the rising rates has opened the door for new loan products to come out. So suddenly we're seeing loan products that we haven't seen in years as rates have risen. Though it's important to note that those new loan products are not coming from the banks. So it's private equity firms are starting to flow back into the mortgage market, and the no income verification doesn't exist, but we've got a bank statement loan now that has come back into play for self-employed borrowers. We've got a no seasoning waiting period for somebody who's had a foreclosure, and no season waiting period for somebody who's had a bankruptcy or a short sale, where prior you'd have to wait 3 years, 4 years, or 7 years.
But I mean, at the end of the day, if you're talking about private equity, they can necessarily do whatever they want with their money, just as long as those products don't make it into those mortgage-backed securities. I mean, are there still controls in place to make sure that that doesn't happen again?
Yeah, so the trade-off with the what I would consider to be the non-conforming type products rolling into the market is that the borrowers have to have some skin in the game. So they've got to put a sizable down payment down, whether they're going to put 20% down, 30% down. And of course, the investor wants a higher return for the higher risk, so the rates are going to be much, much higher. You know, maybe in the 6.5% range to get one of those types of loans. Sure.
It's funny that you say 6.5% range. That's the interest rate that I bought my first house at in 2003 or 4. You know, so yeah. I think it's important for people to keep history into perspective. You know that, you know, the sky is not falling if rates get up to 6%. You know, it's probably historically a pretty average rate.
Absolutely.
Yeah. Okay. Anything else you want to add, Joe or Amy?
Yeah, I think we're talking about the future. I mean, I've actually got we've got a graph here or a slide that we'd like to share. That actually, this is the, if you guys can see that.
We can.
That's the 10-year Treasury yield minus the 2-year Treasury yield. And historically, when those two yields come together, it will signal either a slowdown in the market or a recession. So if you look back to like 1980, you can see that there's a lot of red on that graph. You go to the early 1990s, that's right around where the tech crisis started to happen. 2000, of course, 2008, where we saw you know, the housing correction. And then 2018, you can see that they're starting to come together again. And the way I look at this, I might have a little bit of a unique approach, but I look at this and say, okay, we might see a slowdown in the stock market, and you know, we might see a nice pullback, but I kind of look at that as drive news, and I like to see a market that's going up, or I like to see a market that's going down. I don't want to see a stale market, because when there's a stale market, there's not much going on. Like buyers are sitting on the fence, sellers are sitting on the fence, and there's no call to action. So I think even if we do see a pullback in the market in 2019, I think that's a good thing, because it's drive news, it's getting people to act, and I think it means that we're going to have a good year. Although our 401ks and our IRAs might not feel like it's a good year, but I think as far as housing goes, everybody can do well and make quite a bit of money and get to where they want to go.
Yeah, I think that there's just enough pent-up demand from so many years of people sitting on the fence, you know, from, let's say, 08 through 16, basically. I mean, there was a good 8-year stretch there where not much was happening. And there's just flat out a lot of people that need to buy a home. And, you know, they've got to do something, and rates are still low enough. You know, the American housing market is the place to be in the globe. So I don't see this thing falling apart. That's my prediction. I think if anything, we're going to see a continued cooling off, and it's going to slow down a little bit. But we're at such high levels right now. It had to. It's like the stock market. It can't just keep going. At some point, it's got to come down.
Really great.
Yeah. Okay. All right, Joe. Is that all you had there? I just want to make sure I don't cut you off.
No, thank you. Appreciate the opportunity.
All right. Very good. So that's a wrap, everybody. Thanks for being here. We got out in 20 minutes this month. That's our goal. We want to be brief, quick, fill you up with a lot of information, and be done. So thanks for joining us. We'll see you on December 11th. Have a happy Thanksgiving, everybody. Enjoy it. Bye-bye.